Hey everyone, welcome back to Deep Dive Stock Earnings. Today, we're looking at a company that many institutions call the most reliable compounding machine in North America, Constellation Software, ticker symbol CSU. The company just released its Q3 2025 earnings report, and the results were impressive. Profit jumped 28%, and free cash flow surged 46%. Yet, the stock is still trading near its recent lows. So why is the market ignoring such strong numbers? Is this a trap or an opportunity? Let's find out. Let's start with the results. In Q3, Constellation's revenue grew 16% year over year. Net income rose from $164 million to $210 million. And diluted EPS came in at $9.89 per share. Not only did they beat expectations, they also reversed the slowdown that led to last quarter's sell-off. That's a clean V-shaped recovery right there. If you zoom out and look at the last 5 years, you'll notice something rare. Constellation's growth curve never really broke. This is a company built on a simple but powerful idea. It acquires small, vertical market software companies all around the world, then integrates them into one efficient operating system, optimizing margins and cash flow across the board. It doesn't rely on one blockbuster product. It runs an entire cash machine ecosystem. Now, the big question everyone's been asking: debt. Because in a high-interest environment, debt can quickly become a valuation killer. According to the report, Constellation paid $153 million in interest in the first 9 months of 2025. That sounds like a lot, but here's the twist. They're using that money effectively. Their free cash flow to shareholders came in at $529 million, up from $360 million a year ago, a 46% increase. So they're using leverage to multiply returns, what we call positive leverage. If a company can borrow smart and earn more than it pays, that's not a liability, that's a weapon. Of course, we can't ignore the risk side. Their debt-to-equity ratio is high, which means if rates go up again, interest expenses will rise too. But right now, the returns easily cover those costs. Their ROIC, return on invested capital, remains solid. That's why long-term investors are still confident. Let's talk about valuation. Constellation's forward divided by E ratio has dropped to its lowest level since 2017, well below its 5-year average. In other words, the market is pricing this company as if its best days are behind it, even though the numbers say otherwise. Some investors worry about the CEO's retirement, AI disruption, or macro uncertainty, but none of that shows up in the financial data. Profits are at record highs, cash flow is surging, and ROIC remains strong. That's not what a declining company looks like. Now, let's talk about growth. Over the past decade, Constellation's revenue grew from around $1.05 billion to nearly $10 billion, a compound annual growth rate close to 20%. And unlike most growth companies, they don't burn cash to expand. They earn it, reinvest it, and compound it again. It's a model that feels a lot like Berkshire Hathaway, only focused entirely on software. The company also said in the latest report that they're still actively pursuing new acquisitions and plan to maintain a similar investment pace over the next 12 months. That means the flywheel of reinvestment is still spinning, and that's why many call it a capital allocation machine. Let's move to valuation modeling. After running my own numbers and applying a 30% margin of safety, I get an intrinsic value of about $300 per share. The current stock price on the Toronto Exchange is around $385, which means it's roughly 50% undervalued, even after currency adjustments. Even under a conservative case, a divided by E of 17 and 11% annual growth, the downside looks minimal. In a normal scenario, 20% growth, 30 multiplied by divided by E, the upside could reach 500% over the long term. That's huge, especially for a company that already has a market cap over $100 billion. It shows that Constellation might still be one of the most powerful compounders in the market today. Now let's step back and think about market psychology. The best buying opportunities usually show up when sentiment hits rock bottom. Yes, the CEO change, AI competition, and interest rate worries are real, but they don't fundamentally change how this business works. And the truth is, great companies are often the most undervalued when they're the most misunderstood. Constellation doesn't chase headlines or hype. It doesn't move on buzzwords or trends. Its business runs on discipline, cash flow, and compounding. That's not flashy, but that's how wealth is actually built. So here's my take. Constellation Software is a textbook example of a high-quality stock that's been temporarily mispriced. Earnings up 28%, cash flow up 46%, strong ROIC, Cheap valuation, that's for bullish signals lining up at once. Short term, sure, the market might stay cautious, but for long-term investors, this mix of quality plus undervaluation is exactly what you want to see. If you found this breakdown helpful, don't forget to hit that like button and subscribe. I post deep dive earnings reviews like this every week. What do you think about Constellation Software? Is this a buy, or are investors right to be cautious? Let me know in the comments below. Thanks for watching. I'm Steve from Deep Dive Stock Earnings, and I'll see you in the next one.